Most people spend their lives chasing money. Old money families spend their lives protecting it. That is the difference. While the world obsesses over fast profits, market hype, and overnight success stories, wealthy dynasties quietly follow a completely different set of rules. Rules designed not for attention, but for permanence. And perhaps the strangest part is this: almost nobody teaches these principles publicly. Because real wealth was never built through excitement. It was built through patience, restraint, and time. Tonight, we're uncovering the old money investment strategy nobody talks about, and why it quietly outperforms almost everything else in the long run. There is a reason old money families remain wealthy for generations, while lottery winners, athletes, and entrepreneurs often lose fortunes within a decade. The difference is not intelligence, it is philosophy. Old money does not view investing as entertainment. It views investing as preservation. The goal is not to become rich quickly. The goal is to become impossible to impoverish. And once you understand that shift in thinking, the entire financial world begins to look different. The first principle of old money investing is patience. Not ordinary patience, multi-decade patience. Most people enter the market asking, "How much can I make this year?" Old money asks, "What will still be standing in 30 years?" That mindset changes everything. Instead of constantly buying and selling, wealthy families often hold investments for decades, sometimes generations. Why? Because compounding rewards consistency far more than brilliance. A modest investment earning steady returns over a long period becomes almost unstoppable. Old money investors understand something modern culture ignores. Wealth grows quietly, not dramatically. The stock market may fluctuate daily. News headlines may trigger panic. Speculative trends may rise and collapse. But disciplined investors continue accumulating quality assets while others react emotionally. This is why many wealthy families favor simple, broad market index funds over constant trading. Not because index funds are exciting, but because they are dependable. They remove ego from the equation, and old money avoids ego whenever possible. The financial industry often promotes complexity. Complex strategies, complex predictions, complex products. But old money understands that complexity frequently benefits the seller more than the investor. This is why many sophisticated investors quietly allocate large portions of wealth into low-cost index funds. An index fund does something deceptively powerful. It buys ownership in entire economies. Instead of attempting to predict which company will dominate next year, index funds assume something far more rational, that human progress will continue. Over time, businesses grow, innovation advances, markets expand, and patient investors participate in that growth. Old money families rarely obsess over beating the market. They focus on surviving the market, because survival allows compounding to do the heavy lifting, and compounding, over decades, becomes extraordinary. A person chasing quick returns may look wealthy briefly, but the investor quietly compounding at steady rates often becomes vastly wealthier in the end, without stress, without spectacle, without constant risk. The next principle is ownership of tangible assets, particularly real estate. Old money has always understood the psychological comfort of owning assets that physically exist. Land, property, buildings, things that produce value regardless of market sentiment. While speculative assets can vanish overnight, well-positioned real estate tends to endure through generations. And importantly, old money does not usually buy property for status alone. It buys for cash flow, stability, scarcity, long-term appreciation, a luxury apartment in a desirable city, farmland, multifamily housing, commercial buildings in enduring locations. These assets generate income while increasing in value over time. And unlike trends, land is finite. This is why real estate remains one of the foundations of generational wealth. Not because it is glamorous, but because it is durable. Old money prefers investments that can survive uncertainty. That is the recurring theme. Not excitement, endurance. One of the biggest misconceptions about wealthy families is that they are fearless risk takers. In reality, old money is often deeply risk averse, but not in the way most people think. They are willing to accept short-term volatility. What they refuse to accept is permanent ruin. This is why diversification matters so deeply. Old money rarely places everything into one company, one trend, or one industry. Because concentrated wealth can disappear quickly, diversified wealth survives. Stocks, real estate, private businesses, bonds, cash reserves, sometimes commodities or international holdings. Different assets responding differently to changing economic conditions. This creates resilience, and resilience is one of the most underrated forms of wealth. When markets panic, diversified investors remain calm. When recessions arrive, they endure. When opportunities appear, they have liquidity ready. Old money understands that surviving difficult periods is what allows wealth to compound during prosperous ones. Now we arrive at perhaps the most important principle of all. Old money avoids speculation. This may be the hardest lesson for modern investors to accept. Because speculation feels exciting, it promises speed, exclusivity, insider knowledge, massive returns. But old money is suspicious of anything that depends on hype. If an investment requires constant attention, if it relies on public frenzy, if it promises extraordinary returns quickly, old money becomes cautious. Because throughout history, speculative manias always follow the same cycle: excitement, greed, euphoria, collapse. And the families that preserve wealth for generations understand something simple. You do not need extraordinary returns to become wealthy. You need consistent returns while avoiding catastrophic mistakes. That philosophy may sound boring, but boring has built more lasting fortunes than brilliance ever has. Quiet investing, disciplined investing, emotionless investing. That is the old money way. In the end, the old money investment strategy is not really about money at all. It is about temperament, the ability to remain calm while others become emotional, the ability to think in decades while others think in days, the ability to value permanence over excitement. And perhaps that is why these strategies feel so rare today. Modern culture rewards visibility. Old money rewards stability. One seeks applause, the other seeks longevity. So if you want to build wealth that lasts not just for years, but potentially for generations, begin by thinking differently. Move slowly, invest consistently, avoid unnecessary risk, own quality assets, and give time the opportunity to work for you. Because the greatest advantage in investing is not intelligence, it is patience. And if you want to go deeper into the timeless principles of wealth, investing, and elegant financial living, you can download the Old Money Blueprint guide in the description below. Until next time, remember, true wealth whispers. It never needs to shout.